Master SPX option trading with the day trading GPS SPX key levels indicator for a crucial advantage you need in trading SPX 0DTE options. This powerful tool is designed to help traders optimize their trade entries, improve stop loss placement, and enhance profit-taking strategies by providing accurate daily key levels that can significantly impact your trading outcomes. With this indicator, you can refine your trading process and transform your trading game today, enabling you to make more informed decisions and increase your chances of success in the fast-paced world of SPX 0DTE options. In today's video, we will examine the intricacies of this dynamic SPX 0DTE trading strategy that utilizes the SPX daily key levels indicator. We will be using the strategy for today's SPX trading session, which is Friday, September 5th, 2025. We will be going over how to use this indicator to identify high probability trade entries, establish effective stop loss levels, and secure profits with strategic targets. Okay, so on the chart here today, we have today's Friday, September 5th, 2025 session on a 2-minute chart. This indicator is designed to primarily use on chart time frames of between 1 minute and 5 minutes. The recommended chart time frame is 2 minutes, which is why we have it on that time frame. Okay, so the way this indicator works is that at 9:30 a.m. Eastern Time, when the SPX CBOE index market opens, you will see the levels for today's session on your chart, starting off with the most important level, which is the SPX Bull Bear KPL, which stands for key price level. This is the indicator's Bull Bear key price level for today's session. So this would be bullish above and bearish below. How you utilize this particular level in this indicator is you are in the beginning of the session waiting to see either a cross above and close above that level, or a cross below and close below that level before taking a trade entry. The levels above the Bull Bear KPL, otherwise known as the BBKPL, are your take profit levels on bullish entries. The levels below are your take profit levels on bearish entries, both of which are triggered when triggered from this BBKPL level. The midpoints above and below the BBKPL are your standard stop loss levels for entries triggered from the BBKPL. So in the case of a bearish entry, which would be a cross below and close below the BBKPL, your standard stop loss for that bearish entry is the first midpoint level above the BBKPL, which is the mid BBKPL R1. So for today, that's 65.2142, and the Bull Bear key price level for today is 65.1492. Conversely, on a bullish entry triggered from a cross above and close above the BBKPL, your standard stop loss on that long trade entry that would be triggered from the BBKPL level is your first midpoint below, which is the mid BBKPL S1, which today is 65.0843. These levels can also be used later in the session for entries, bearish or bullish entries. And when you take a entry later on in the session based on price action that's happening at those levels, you would use the same methodology for your stop loss levels. So if, for example, you were taking a bullish entry, let's say on the S3 level, then your standard stop loss for that would be the first midpoint level below, which would be your mid S3, S4 level. Conversely, if you were taking a bearish entry, say off the R2 level, then your standard stop loss for that level being triggered by that entry level would be the first midpoint above, which would be mid R2, R3. But the majority of your trades are going to be triggered from the bull bear key price level, because that is the level in play during the morning part of the session. Okay, so in today's session, we have a gap up from yesterday's close, and we have a significant gap above the indicator's bull bear key price level for today. So as you can see here, we do not have a cross above or a close. We don't have a cross above and close above, or a cross below and close below, because the price is gapped up way above today's bull bear key price level. So in instances where something like this happens, then you're still waiting to see for price action to develop around the bull bear key price level, specifically a cross above and close above, or a cross below and close below. So in this case, there would be no trade at this time at the market open, because you're waiting to see price come back down towards the bull bear key price level and actually cross below and then close the candle back up, or cross below and close that candle below. If you were of the mindset that you did want to take a trade based on this gap up, then as I've noted here in this note here, then what you would want to see in that case, let's say this was a session in which we gapped above and we continued moving above for the rest of the session, and there was no retrace back down to the bull bear key price level, then as I've noted here in this note, what you're looking for there is you want to see price continue up and close above the next level above. Then you want to see confirmation of the continuing move by seeing a successful retest above that first level above as well. So you would want to see price move above to the next level above, successfully retest that level, and continue the move above before entering a bullish play on a gap and go. So a gap and go would be where it would be gapping above even the bull bear key price level on a significant gap above, such as this R1, and it would continue to go. If price was down here closer to the bull bear key price level and happened to open above and close above, but it was more in this range here between the midpoint and the BBKPL, then you could enter a bullish trade there, having this as your stop loss here. But in this case, since we have such a significant gap above and we're gapping above the R1 level, then ideally what you would want to do is wait to see what happens when price retraces back down. So in the odd chance that it does continue on a gap and go, that would be your conditional rules for entering a trade. So you would still not enter a trade here on a gap and go. If the price had instead continued to go up, you would wait for a close above the next level above, and preferably for a retest, successful retest of that level, for continuing to move up before entering long on a trade on a gap and go. Okay, so what does happen here is we have a move sideways, and then we have a move back down towards the bull bear key price level. There still is no cross here, so we have no cross and then reaction from that cross until this candle here at 10 a.m. So at 10 a.m. here we have a cross below. Price does not close back above and instead closes below. And this is a pretty decisive close below here. And so that is your entry signal. It's a bearish entry signal because it's cross below and close below. So your stop loss on this trade is the first midpoint above the BBKPL, which is this mid BBKPL R1 level here. The buy price on this candle close, when it closed, would be for the strike price of a put option that's closest to the BBKPL level of 65.1492, so that would be your 65.15 strike. So you would buy a 0DTE SPX 65.15 put option, and the price on the close of this 2-minute candle here is $14.75 per contract, so that is per contract $1,475. We'll be also looking at the Thinkorswim charts for the 65.15 put option later on in this video, where you can see the timestamps and all the data regarding the buy prices and also these prices here when it hits these levels. So as you can see here, even though we did, after entering here on this close of this candle, we did have a little bit of a retrace back up where this wick hits the BBKPL, but instead falls off and still closes below. So as you can see here, after entry here, there was no, it did not even come close to touching or breaching the standard SL. Okay, so at 10:14 a.m. SPX hits the S1 level. The 65.15 put is now $22.41. You purchased at $14.75, so you have a nice profit that is emerging here. As you can see in the next candle, it hits the mid S1, S2 level, and at 10:18 a.m. on this candle here, SPX hits the S2 level. The 65.15 put is now $32.60 on this candle close. At this point, you would close out 100% of your contracts that you entered here on this bearish entry, because we have a full 2-level move, meaning we have an entry from the entry signal level. So the entry signal level is the BBKPL. S2 is the second main level down, so that's a full 2-level move. So at this point, you'd be selling at $32.60. You bought at $14.75, so that is $17.85 profit per contract, which equals $1,785 profit per contract. If, however, you're trading multiple contracts, and that would mean at least 3 or more contracts, preferably 4 or more contracts, then your alternative here, if you do not want to close out all 100%, is that if you're trading multiple contracts, you can close out between 70% to 90% of them when it hits this level, and then you would leave the remaining ones as runners and adjust your stop loss on those runners that are remaining. So for example, if you were trading 5 contracts and when it hits this level here, if you sold 4 of those contracts, that would be 80%, since 4 is 80% of 5, and then you would leave 1 contract as a runner. You would adjust your stop loss at that point by either moving your stop loss down to the BBKPL or the first midpoint below the BBKPL if you're adjusting it by your stop loss by levels. If you're adjusting your stop loss by price, then you would want to adjust your stop loss to where now it is at least equal to $14.75 what you paid, so that would be a break-even stop loss, but more preferably you'd like to make it more than $14.75. Since now we're at $32.60, you would like to make it more than $14.75 break-even, so that if price reverses, you still are going to have a profit on the remaining runner. What that specific adjustment would be completely up to you as to how much profit you want to leave. You also have to keep in mind that you do need to allow it some room to breathe to keep moving down, because you will get these brief retraces even on a sharp move down as we have here. So you would like to strike a balance between if you're not going to put it at break even and you want to add an amount of profit per contract on adjusting the stop loss on the remaining runners, you want to leave some room but also lock in a significant amount of profit. Okay, so if you did leave runners at this point, then whatever runners were left at 10:28 SPX hits the mid S2, S3 level, the 65.15 put is now 42.20. Then just 12 minutes later at 10:40 a.m. SPX hits the S3 level, and now the 65.15 put is now 55.48. At 11 a.m. SPX hits the mid S3, S4 level, and the 65.15 put is now 65.30. And as you can see here, we have bottomed out here for the time being in this session, and we've started to move back up. So if you did get out down here, and for example you wanted to take a long off of this level here using some of the profits that you have from earlier in the session, then your stop loss for that long entry trade would be the S4 level, because that's the first level below this midpoint level. Okay, so recapping the trades here on this Friday, September 5th, 2025 session, we had an entry of an SPX 0DTE 65.15 put option. The buy price was $14.75 per contract on the 10 a.m. cross below, close below the BBKPL. So right now we're going to take a look at the Thinkorswim option chart with all the data boxes for all these prices, and then we'll return back to this chart. Okay, so here's the Thinkorswim chart for the 65.15 put option for today. Here we have the 10 a.m. entry candle on cross below, close below the BBKPL, which happened at 10 a.m. So as you can see here, the close of that candle, $14.75. You could have gotten a better price intra-candle. However, it's best to wait for the candle to actually close, because that way you know which direction that we're going. So just remember that it's best to wait for a candle close, and that way you have confirmation of whether this is going to be a bullish or bearish entry, because if before the candle closed it moved back above the BBKPL, then you'd be looking, and closed above the BBKPL, then you'd be looking at a call entry instead. So you're paying a little bit more, but you're also getting confirmation. Alright, so $14.75 here. So here's the 10:14 a.m. candle when SPX hits S1. So here that put option is now up to 22.41. Here we have the 10:18 candle, which SPX hits the S2 level. This would be where you would have closed out 100% of your contracts, or if you were trading multiple contracts, you would have the option of just closing out 70 to 90% of them, adjusting your stop on the remaining runners. However, if you did close out 100% here, the price is $32.60. If you do have remaining runners that you adjusted the stop on, then later on at 10:28, SPX hits the S2, S3 level here, and now this option is up to $42.20. Just 12 minutes later at 10:40, SPX hits the S3 level, and the 65.15 put option is now 55.48. 20 minutes later at 11 o'clock a.m., SPX hits the mid S3, S4 level, and at that time, on the close of that candle, the 65.15 put is now 65.30. Okay, now we'll go back to the other chart. Okay, now we're back on the other chart, and we'll go through the rest of this. So as you said, the S2 level hit at 10:18. The 65.15 put was now $32.60 per contract. 100% close out of the contracts on a two-level move in your favor. Again, what that two-level move is what that means is from a two-level move from the level that the entry was triggered from. So in this case, it's triggered from the bull bear key price level. So a 2-level move on a bearish entry from that level is the S2 level below. At 32.60, the profit, because you paid $14.75 a contract, is $17.85 per contract. That's $1,785 per contract. So if you had one contract, that's $17.85. If you had 10 contracts, that's $17,850. So again, as I mentioned before, alternatively, if trading multiple contracts, that would mean at least 3, but ideally 4 or more if you're using this strategy. Then you could close out 70% to 90% on the 2-level move in your favor and leave runners after adjusting your stop loss on the remaining runners. If you did have remaining runners, then at 10:28, when it hits mid S2, S3, the 65.15 put is now 42.20. So that's a profit of $2,745 per contract. 12 minutes later, at 10:40, it hit S3. The 65.15 put is now 55.48. The profit on the runners remaining is now $4,073 per contract, and so that's a profit of $40.73 per contract. 20 minutes later at 11 a.m., it hits the mid S3, S4 level. 65.15 put is now 65.30. The profit on any runners that are remaining is now $50.55 per contract, so that's $5,055 per contract. If you're interested in purchasing this indicator, you can email us at daytradinggps@gmail.com and request a promo code for a discount on purchasing the indicator. You'll see in the description of the video a link that you would go to purchase the indicator, but before you do that, please email us at daytradinggps@gmail.com to request the promo code for the SPX Daily Key Levels indicator. Thank you for taking the time to watch this video, and we wish you much prosperity in all of your future trading endeavors. Thank you.